Hey there, how's it going? I'm Jason. I'm your host. Welcome to the week in YouTube Finance.
Our interest payments are higher than our Defense Department budget. If we didn't do something about this, then there won't be any money for anything.
So what if the safest, most stable investment in the world, the foundation of pensions, retirement accounts, and entire countries, is starting to break?
But the longer term is still uncertain, and the market response to the back and forth has been volatile, especially when it comes to the bond market.
You are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic.
Now that was Jamie Dimon, the CEO of JPMorgan Chase, which manages about $4 trillion in assets. And he put out one of his most serious warnings, and he's not alone. We're already seeing huge cracks overseas. In Japan, the 30-year government bond has erased about half of its value since 2019, going down by about 45%. Just in the past year alone, the interest rates went up by 100 basis points, causing unrealized losses for Japan's biggest life insurers. Now, in the United States, we have over $36 trillion in debt, a debt-to-GDP ratio of about 124%, and yearly deficits pushing above 6%. Now, for context, that is more than double the 3% level economists usually say is sustainable for a healthy economy. And if Japan, which was once the center of global financial stability, the country that lends its money to all other countries, is flashing warning signs, and JPMorgan is sounding the alarm here at home, I think it's worth paying attention to. Because if the bond market really starts to crack, it could threaten way more than just your investments. It might unravel the entire global financial system. Today, I'll break down exactly what's happening behind the scenes, why this is so important, what it means for our money, our future, and how I'm personally investing. So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the drama. So in today's video, you're probably going to learn more about economics than any of my other videos. But before we get into the juicy stuff of the drama between Elon Musk and President Trump and Jamie Dimon's warning and everything in between, first, you have to understand exactly what's happening in the United States, because all of this integrates directly with the federal deficit, the national debt, and at the center of all of this is the bond market. Now that will explain everything that's happening right now. But first, let me just explain something important. Whenever you hear finance nerds talk about yields or interest rates, they're basically saying the same thing. The yield on a bond is just the return or interest rate that you get from loaning your money to the government or a company. And when bond prices drop, their yields or interest rates go up and vice versa. But here's the problem. Today, these interest rates are going up at a historic pace. In fact, the yield on what's called the 10-year Treasury bond, which is sort of used as the benchmark to determine interest rates, went up from less than 1% in 2020 to almost 5% today. Now, to put that into perspective, that's the fastest jump that we've seen in the last 40 years. And it's creating a huge pressure on banks, governments, and financial institutions. But the question is, why are those rates going up? That's the opposite of what we want, right? And here's why. When investors start to doubt a country's ability to pay back our interest, they demand higher yields to compensate for taking on that additional risk. For example, if you were going to let someone borrow your money and maybe you're not 100% sure they were going to pay you back, you'd probably want just a little bit of extra for taking on that risk. That's why rising yields or rates are a lot of times seen as the first warning sign of trouble ahead. And unfortunately, the interest rates right now in the US are going up, not just in Japan, but also here at home. Now, to fully understand exactly how we got here, though, I want to share with you an incredible presentation by economist Lynn Alden. She also put out a book called Broken Money, which, by the way, I strongly recommend if you're a finance nerd. Link is down below. But Lynn Alden described exactly why we're trapped in this cycle of rising debt. Let me walk you through each piece of her research step by step, because once you see it, your mind is going to be blown away. Now, the first piece of Lynn Alden's research I want to show you helps explain exactly how we got stuck here and why this situation seems impossible to fix. Take a look at this chart. On one side, you have the unemployment rate in red, and on the other, government deficits in blue, which is how much more money the government spends than it collects through taxes each year. Now, normally, these two lines move together in really predictable cycles. When the economy is strong and unemployment slow and people have jobs, governments collect more taxes and they spend less money, so deficits shrink. Then, during recessions, the opposite happens. When people lose their jobs, deficits go up as governments step in to support the economy. But notice something strange that started to happen around 2017. Even as unemployment rates went down to historically low levels, the deficit started going up much faster. In fact, today, our yearly deficit is around 6% of GDP. Again, that's double the level that economists usually consider healthy, and that's not good. It's like the government spending money as if we were in the middle of a recession, even though the jobs numbers say that the economy is really strong. And that means we're borrowing at a pace that's normally reserved for economic emergencies. And here's why that matters. The more money we borrow, the more bonds we have to create, and the more the debt piles up. Over time, that makes investors very nervous. And when investors get nervous, as we talked about earlier, the interest rates start to go up. When rates go up, the value of the bonds go down. That's sort of the trap that we're in right now. We're borrowing really heavily, even in good times, which sets us up for some serious trouble as soon as investors lose that confidence. Now let's look at the next slide, which shows another really important piece of this puzzle. Now in this chart, it's comparing that real interest rate to the price of gold. Real interest rates are measured by the interest rate you earn on a bond, typically the 10-year Treasury bond, minus something called the CPI, the Consumer Price Index, which is how economists measure inflation or the rate of growing prices. So real interest rates, again, are 10-year bond rates minus inflation. Now, historically, when real interest rates are high, investors want to buy bonds because you can comfortably earn interest above inflation, keeping the purchasing power of your dollar. But when real interest rates go down to almost zero or even negative, investors start looking for better places to put their money. Now, for decades, gold prices moved almost exactly in line with real interest rates. But look at what's happened recently between 2022 and 2023. The two decoupled. Gold prices are now moving in the opposite direction of real interest rates. Why? Because people are not rushing back to bonds right now. Instead, they're shifting their investment strategy toward scarce assets that can't be printed or devalued. And this suggests that investors all over the world are starting to doubt the sustainability of the current financial system, which is built on ever-increasing debt. Now, the third slide from Lynn Alden's research shows something that's really interesting. This chart compares two types of debt growth. Private debt, that's the blue line, which is money borrowed by businesses and everyday people like you and me, and public debt, which is the red line, which is money that's borrowed by the government. Now, throughout history, private debt has usually grown faster than government debt, except during recessions, which is when governments step in to borrow and stimulate the economy, so that makes sense. But something big changed after the 2008 financial crisis. Government debt growth started consistently outpacing private debt even during economic expansions or times of growth. So even though we're not technically in any crisis, our government is borrowing money like we are. And that's why investors are worried. And here's why that's a major, major problem. The more governments borrow, the more bonds they issue. But who's going to keep buying all these new bonds, especially when debt levels are already so high? At some point, investors start doubting whether all of this borrowing can really be repaid without borrowing more money. It's a catch-22. Now, I just want to take a step back and say that right now we're in a new cycle where everything changes really fast, so understanding the trends matters more than ever. And it's one of the ways that I was able to make almost $10,000 with one of my stocks using Moomoo. Thanks to Moomoo for supporting the channel, and now let's get back to it. Now, Lynn Alden's fourth slide is maybe one of the most eye-opening ones because it brings all of this together in a simple visual. Take a look at this chart. In red, you're going to see the US federal debt to GDP ratio, which measures how much debt the government has in relation to the size of the entire economy. And in blue, you have interest rates, which are based on the 10-year Treasury bond rate. Now, here's what's crazy though. Back in the 1980s, US government debt was pretty small, only about 30% of GDP. But interest rates were very high, well into the double digits. But since then, we've been on this decades-long trend where every year debt levels have gone higher and higher, while interest rates have gradually come down lower and lower. And what this has done is it's made borrowing feel more manageable. Sure, we borrow more money, but lower interest rates means that we pay less to service all of that debt, so it kind of equals out. But now we've hit this crucial turning point. Interest rates can't go that much lower. And lately, they've actually started going up again. Remember, investors demanding higher interest for higher risk because our debt is at the highest level it's been since World War II. Now, we currently owe over 120% of everything the US economy makes in a year. And that's a huge problem because now, when interest rates go up just a little bit, our government has to spend so much more money just to pay the interest on the existing debt. And I know that sounds really confusing, but I like to compare it to sort of how the older generation criticizes the young generation. It's like, well, back in my day, I was able to buy myself a house and I paid 15% interest because I could afford it and I worked really hard. It's like, no, Grandpa, you could afford it because houses cost 2 raspberries. But when houses cost a fortune, even 6% is incredibly unaffordable. That's essentially what we have right now, except on a national level. Sure, the rates are relatively low to where they were in the 80s, but our mortgage amount, aka our debt, has never been higher. So we can't sustain these higher rates. And that's why Jamie Dimon's pointing out that if the bond market starts to crack under this pressure, we're going to be in a lot of trouble. Now, this next slide from Lynn Alden's research ties directly into why our government keeps borrowing so much money. This chart right here is the Social Security Trust Fund, which shows us how much money the government has set aside to pay for future retirement benefits. And you can see that it started from basically zero in the 1980s, and it grew steadily for decades. And then it peaked sometime around 2017 at about $3 trillion. But now it's dropping really fast, and it's expected to hit zero within the next decade or so. Why? Because of demographics. Japan is the perfect example of this, but we also have a problem in the US. Baby boomers, which is the biggest generation in US history, are now retiring by the millions. And the government has to pay their benefits, everything from healthcare to Social Security. And for years, the government collected extra money from boomers while they were working, but unfortunately, our government did not invest that money really well. That Social Security Trust Fund went mostly into US Treasury bonds, whose real interest rates were about in line with inflation. So now that boomers are retiring, the government is forced to sell those bonds back into the market to pay for their benefits, draining that trust very fast. And here's the bigger problem. If that fund runs out, the government can't just stop paying Social Security because those benefits are guaranteed by law, and retirees depend on them to live. So the government only has 2 choices: raise taxes, which no politician wants to do, cut spending, which no politician wants to do, or borrow even more money, which just pushes us deeper into this entire cycle. Again, bonds are at the center of all of this, and this demographic shift sort of explains exactly why the government debt problem is not just temporary, it's structural and basically unavoidable. Now, in one of the last slides from Lynn Alden's research, it really drives home just how deep this rabbit hole goes, because take a look at this chart. It's called the debt Ponzi, because the system that we live in today relies on the constant need to borrow money. Here's why. These charts show two very important things. The total debt across the entire US economy in blue, which combines government debt and private debt, and something called the monetary base, which is in orange. It's basically how much money the Federal Reserve has printed into existence. Now, the difference between the monetary base and the total debt essentially shows us how much leverage there is in the system. Now, notice something kind of incredible. Since the 1960s, the total debt in the US has only ever gone down once. And even then, just by a little. That was during the financial crisis of 2008, which is one of the worst things to happen to the economy in my entire lifetime. And that's when the debt briefly went down by just about 1%. So this little tiny dip right here is just a small deleveraging of our debt. Now, in the last 110 years, though, Lynn says that we've only had a grand total of 5 total years where this blue line has ever dipped. The Great Depression, which is between 1930 to 1934, and the 2008 financial crisis. That's it. That's the only time our economy has delevered. Now, in 2008, unbeknownst to high school Andre, the total monetary base that made up the economy was about $1 trillion. But the total debt was $50 trillion, meaning in 2008, the economy was levered 50 to 1, which is insane. That means there's a lot of risk in the system. But fast forward to today, and our total debt stands at an astonishing $100 trillion. And any attempt to seriously reduce that debt actually risks collapsing the entire system. And that's why Lynn calls this entire financial setup a Ponzi-like system, because it relies on the ever-increasing debt and continuous money printing just to keep itself going. And here's the catch. The more money we print, the higher the risk of inflation and currency devaluation. And when investors start to realize that this is happening, guess what they say? If I'm going to let the government borrow my money, I better get paid more because I'm taking on a higher risk. They demand higher yields for bonds. It all circles back again and again to the bond market, the foundation of the entire financial system. So then the question becomes, have we ever been in this scenario in the last 100 years? And it turns out, yes, we have. It happened once, back in the 1940s. Now, this is probably the most important chart to study because it tells us something incredibly important. This is a 100-year chart showing how debt in the US economy has shifted between these two different types, the government debt in blue and non-government debt or private debt in orange. Notice something amazing. The debt was shifted before in the past. Back in the 1940s, right after World War II, just like today in the 1920s and 30s, private debt grew so fast until it reached unsustainable levels. Eventually, that bubble bust, leading to the Great Depression, and then the government stepped in to borrow and spend massively, causing government debt to skyrocket. The economy shifted from a private debt-driven economy into a government debt-driven economy. After World War II, the government was loaded with debt, just like today. But how did they fix it back then? They didn't exactly pay it off. Instead, they slowly lowered their debt through something called financial repression. Basically, they kept interest rates artificially low, and they encouraged inflation to eat away at the value of that debt. And then they gradually shifted the burden back to the private sector over decades. Now, the government successfully got out of that mess by shifting somewhere else, but it took a really long time, and it required huge economic adjustments. But here's the problem for us today. We solved the debt in the 1940s because we had room to lower rates, to boost our economic growth. And the country had strong demographics, none of which we have today. Inflation's already a big concern, and interest rates are actually going up, not down. So yes, we can see clearly from history that these debt cycles have happened before, but we're now facing a very different set of circumstances where the tools that we use to get us out of that situation are already being used today. So clearly the system is strained. And the trillion-dollar question is, what's the best thing that I can do to protect myself against all of these different economic outcomes? And that obviously depends on person to person. But for me, at my age, at my risk level, at my current situation, I just buy the US stock market via an ETF called VTI because I think it stands to profit no matter what the outcome is. But if all of that is wrong and we're going to pivot into a new economic system, I also buy Bitcoin because it stands to become a lot more valuable if the assumption is we try to print our way out of it by printing more base units to increase our base monetary supply. But I also own real estate and I have some cash on the sides just in case everything else fails, and maybe there's some opportunity. But each bucket of my net worth represents anywhere between 20 to 25%, and that's how I'm personally playing this out. Obviously, that's not necessarily going to work for everyone, but that's my approach. And I think at this point, not owning any hard assets is more risky than owning them. And by hard assets, I'm referring mostly to things like gold and Bitcoin. My hard asset of choice is obviously Bitcoin, but it's not for everyone. However, if you are new to Bitcoin and you want to learn how to buy it, how to store it, how to protect it, I have a step-by-step guide that shows you how to do that. You can use coupon code Andre40 to get an additional 40% off the purchase price. As always, I'd love to hear your thoughts. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'll see you soon. Take care.
Meltdown. The Elon Musk and Donald Trump alliance has gone up in flames. Total and utter flames.
This morning, a growing rift between the president and Elon Musk.
I'm very disappointed in Elon. I've helped Elon a lot.
We have all wondered when these two would fall out, but could anyone have predicted that when it did happen, it would spiral so fast?
Look, I don't know what happened in 24 hours. Everybody can draw their own conclusions about that.
What's up, you guys? It's Graham here. So this is not the video that I was planning to post today, but over the last 24 hours, all hell has broken loose and Elon Musk is going head-to-head with Donald Trump. Normally, I don't cover topics like this on the channel, and I prefer to keep it specific to investing, personal finance, and real estate. But the fact of the matter is, what's being said is having a significant impact on the markets, with Tesla stock plummeting as much as 17% in a single day, and Elon predicting a recession towards the end of the year. Plus, I'm not gonna lie, there are some valid concerns with the unsustainability of endless money printing, which is a topic that's actually worth diving into. This is why we really have to talk about exactly what's being said, the problems with Trump's new tax bill, why Elon Musk now wants the president impeached, and what this means for you watching. Because despite the market falling, there could be some seriously good buying opportunities if you know what to look for. Although before we start, if you appreciate one-off videos like this, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. Doing that gives me a really good indication if these are the types of videos you want to see more of, and as a thank you for doing that, I will do my best to read and reply to as many of your comments as I can. So thanks so much, and also a big thank you to Magic Mind for sponsoring this video, but more on that later. Alright, so in terms of where this begins, let's start here with Elon Musk. I think it goes without saying that Elon has been a huge proponent of getting Trump elected in 2024, reportedly having spent over $250 million to make this happen. In fact, throughout most of Trump's campaigns, Elon was right next to his side, and with the help of his influence on X, it's pretty safe to say that there was significant pull to win the election. And this is where things get very interesting. Shortly after taking office, Trump put Elon Musk in charge of the Department of Government Efficiency, with the main goal of lowering the federal deficit, cutting wasteful spending, and making sure our tax dollars were put to the best use possible. In fact, within the first few months, Musk's team fired or bought out about 250,000 government workers to eliminate wasteful roles, and they initially went in with the expectation of being able to save $1 trillion. But pretty soon it became evident that the cost-cutting measures were falling short. His own companies began receiving significant backlash, and he was quoted as saying, "Being attacked relentlessly is not super fun. Seeing cars burning is not fun. In the grand scheme of things, I think we've been effective. Not as effective as I'd like, I think we could have been more effective, but we've made progress." Essentially, his measures fell short due to legal hurdles and resistance within the courts, causing him to take a step back and focus more of his time on Tesla. Until he saw Trump's big, beautiful tax tax bill. For those unaware, this bill would extend the Tax Cuts and Jobs Act from 2017, boost spending on military and border security, reinstate bonus depreciation, eliminate taxes on tips and overtime, and raise the debt ceiling to compensate for some of the lack of revenue. Which leads us to the next problem. It's very expensive. For example, the Congressional Budget Office estimates that it would add around $2.4 to $3 trillion to the national debt over the next decade. And other analysts say it could actually be as high as $4 trillion. For Trump, this works because the tax breaks could help be a boost for the entire economy. But for the long-term health of America, we're printing and spending more money that we just don't have. And for Elon, this completely undoes all of the work he was doing with Doge. After all, imagine spending months cutting government spending while receiving significant backlash, only to have all of your work undone 20 times over in a few weeks with one single bill. Elon even called it the Big Ugly Bill after saying the new tax plan nullifies the $180 billion in spending cuts made by Doge. Shortly after, Elon blasted the legislation as a disgusting abomination that would bankrupt the country by inflating the deficit, and later he called it a debt slavery bill that would shackle future generations with massive debt. From there, on June 4th, Elon Musk tweeted that bankrupting America is not okay. The bill. And this is where things take a turn for the worse. On June 5th, Trump publicly responded to Elon Musk, saying that he was very disappointed and that he's helped Elon a lot. Trump also said that Musk knew the inner workings of the bill better than almost anybody sitting here. But Elon responded with a false. This bill was never shown to me even once and was passed in the dead of night so fast that almost no one in Congress could even read it. Instead, Trump says that the real reason Elon Musk is upset is purely out of self-interest because Trump's bill would be eliminating the $7,500 EV tax credit. Although before we go into that, I just want to say that it's a lot of work going through hundreds of back and forth tweets. So anytime that I need to focus without loading myself up on coffee, I grab myself one of these. Magic link down below. And now let's get back to the topic at hand, the $7,500 electric vehicle tax credit. Now, even though this is objectively true and eliminating the tax credit would have a negative financial impact on Tesla, it's also theorized that it could benefit Tesla long term because selling EVs overall is rather unprofitable. For instance, once the EV tax credit expires, automakers would be forced to take massive losses, while Tesla stays profitable and gains even more market share. Or I guess in other words, while other manufacturers are losing an average of $6,000 a car, Tesla is making $6,000 a car. And if the EV credit goes away, Tesla would just be able to run the other unprofitable companies out of business. Elon Musk even said it himself. Back in 2021, he recommended Congress get rid of the EV credit altogether. This is why when Trump said that Elon was wearing thin and just went crazy, Elon snapped back calling it a lie. But Trump quickly doubled down on that. He said the easiest way to save money in our budget, billions and billions of dollars, is to terminate Elon's government subsidies and contracts. I was always surprised that Biden didn't do it, effectively publicly threatening Elon that if he doesn't back down as soon as possible, there could be some rather severe financial losses. But Elon then responded by saying that without me, Trump would have lost the election, the Dems would control the House, and the Republicans would be 51 to 49 in the Senate. Such ingratitude. This is pretty much where things devolved rather quickly, leading to Tesla's largest single-day loss on record, and Elon digging up something that always comes to bite you back in the ass. Old tweets. See, in terms of the federal deficit, back in 2013, Trump was publicly against raising the debt ceiling, calling himself embarrassed and that no member of Congress should be re-elected if our country's budget isn't balanced. Honestly, this entire situation just escalated so quickly to the point where Elon was live tweeting Trump's press release. And then he began calling out other members of Congress who were previously in favor of cutting costs, now backtracking entirely and promoting a bill that would raise the federal deficit once again. And then, you can't even make this stuff up, Elon started tweeting about Trump associating himself with the Bad Man Files. And the reason we haven't seen them yet is because Trump's in it, even going so far as to post a video of the time the two of them were together. From there, Elon Musk retweeted a post saying that Trump should be impeached, while saying that a recession will take place later in the year due to ongoing tariffs. Of course, others have been very critical of Elon Musk, citing his, erratic appearances at a recent meeting, with a black eye. Some sources believe that this could be the reason for his outburst lately, but regardless of the reason, the toll on the market has been severe. In one day, Tesla lost $150 billion in market cap. $285 million was wiped out from the cryptocurrency market in 60 minutes, and Trump says if the bill doesn't pass, there will be a 68% tax increase. So what does all of this realistically mean for you? Well, here's my honest perspective from someone who doesn't take sides. I don't care either way, and I have nothing nothing to gain or lose by saying this. I find it in really bad taste that all of this is playing out so publicly, live, back and forth, when the country would benefit the most by being unified. Maybe it's too idealistic to expect that these matters would be handled privately behind closed doors, but objectively, I do think the country would be much better off if we didn't have so much political back and forth. Of course, I get it. The counter argument to this is that this allows everything to be aired out in the open publicly so that all of us could see exactly what's happening in real time, and then come to a decision ourselves. Although in terms of how this impacts you, here's the honest truth. Short term, I would expect to see a lot more volatility. Flat out, investors hate this type of uncertainty, so I wouldn't be surprised if we see more market turmoil. But long term, I wouldn't expect this to have any meaningful consequences, and it doesn't really change anything about the market fundamentals. Like sure, not passing the new tax bill will most likely have a bit of a drag on the economy, but let's also be real. A new tax plan is most likely going to pass, and there will be spending increases because Congress loves to spend money. It is wildly unpopular to cut spending or raise taxes, so the only thing left to do at this point is just to print more money. Is this a problem for the national debt? Yes, absolutely. But is it a problem right now, this very second? Probably not. I hate to say it, but it seems like a lot of politicians only care about their next term, and if that includes spending more packages to push some random stuff through, so be it. It'll probably just continue happening until eventually it's too late. When could that be? Well, honestly, we could probably just keep spending more and more and more money for decades. Money that we don't have. The only cost is going to be a devaluation of the US dollar and a weakening position of the United States as a dominant superpower. But it's nothing our grandkids can't fix. Hopefully. That's why I think that Elon is highlighting a very real, serious problem, but I don't have faith in the government to actually do anything about it. Honestly, I think it's a good buying opportunity. I'm not changing anything about how I invest, and I don't think this changes anything fundamentally long term. I just think, as nice as it is to have the belief that the government has the potential to operate efficiently, I don't have high hopes that this could be accomplished, and it just seems like a losing battle. Like sure, you'd be able to save a few pennies, but at the rate the government is currently spending, any resources would probably just be better spent elsewhere. If you think I missed anything, by the way, in the entire situation, since a lot of this is changing by the minute, feel free to leave a comment down below, and I will do my best to read and reply to as many of you as I can. And also let me know if you enjoy these slightly off-topic breaking news videos, and if enough people enjoy them, I'll do more of them. So thanks so much, make sure to hit the like button, subscribe, and until next time.
The housing market just saw its biggest shift since the pandemic. Take a look. For the first time in 12 years, home sellers outpace home buyers. That means yes, price cuts are finally here. That's good news if you want to buy a house, but it's not so good news if you're thinking about selling your house. But there's one more factor on the table that could flip the housing market again. Want to guess? Lower mortgage rates. Potentially. The Federal Reserve Bank is now seriously considering lowering interest rates to stimulate the economy and to stimulate the housing market. That's why in this video, I want to break down what's happening in the housing market so you have a better idea of what might be coming, because things are changing very quickly. To understand where the housing market's going, you have to understand where we've been. Let's assume you wanted to buy the median house in America. If you bought this median house in America after the pandemic in 2020, you were in a buyer's market because nobody wanted to buy a house. Nobody wanted to leave their homes, so you had a lot more leverage as a buyer. The median house in America in 2020 after the pandemic was around $387,000, plus the average mortgage rate in 2020 was 3.4%. That means if you put 20% down, your mortgage payment would have been around $1,373 a month. By 2021, the housing market flipped because people weren't as scared to leave their houses and people wanted to take advantage of these low mortgage rates. Now everybody and their moms literally wanted to buy a house, and they were willing to bid for those houses. In fact, we were seeing a record number of bidding wars in 2021 with people paying way over asking prices for homes, so home prices shot up in 2021. By mid-2021, a little over a year and a half later, the median house in America was selling for $470,000, while mortgage rates in America fell. The average 30-year mortgage rate was now 3.1%. That means now if you bought the same median house in America, you put down 20%, your mortgage payment would now be about $1,816 a month. But now let's fast forward to 2025 because it looks like things have peaked. Home prices have gone up and up and up. But now, because housing has become so not affordable, sellers are now being forced to give concessions and cut prices on their houses. Take a look. By April of 2025, the median house in America is now selling for $585,000, which, by the way, I'm using the US Case-Shiller Index to come up with all of these house numbers because there's a lot of different indexes out there that measure housing prices. Some are a lot higher than others. I'm using the Case-Shiller Index, while the average 30-year fixed mortgage rate is 6.5%, which means, yes, you're borrowing more money, but you're also paying more interest to borrow that money. So if you put down 20% to buy the same median house, that monthly mortgage payment is gonna cost you $2,950 a month. Now you can start to see why housing has become so unaffordable. The median house in America has jumped up in price by more than 50%, and the monthly mortgage payment on the same house has jumped up by around 115%, because not only are you borrowing more dollars, but you're paying a higher interest rate. Yes, we've been covering all this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the housing market, stocks, crypto, the global economy, and our own economy into a fun, witty, and easy to read newsletter. It's read by hundreds of thousands of investors every morning. Plus, when you join Market Briefs, you'll also get my investing masterclass where I break down, number one, how you can start investing and building your wealth, but also how do you stay on top of and find hidden investment opportunities before everybody else. So if you want to get this investing masterclass plus Market Briefs, all you have to do is click the link down in the description below. And yes, the newsletter and the masterclass are free. And to really hammer this point home, you should also know that the median income in America has grown between 2020 and 2025 by about 20%, meaning the cost of housing has very much outpaced incomes. And this makes it very apparent that, yeah, maybe housing got a little bit too expensive, especially with mortgage rates going up, which is why now the housing market trajectory is downwards, because we're seeing more seller concessions, we're seeing more price cuts, we're seeing more sellers enter the market than buyers. And so now we have sellers competing against each other to sell their houses, as opposed to buyers betting against each other through bidding wars. Remember, housing prices are determined by supply and demand. When you have more buyers than sellers, more demand than supply, housing prices go up. That's what we saw in 2020, 2021, 2022, 2023, and a little bit in 2024. When you have more sellers than buyers, more supply than demand, that pulls housing prices lower. And that's what we're seeing now in 2025 as more sellers enter the market and more buyers are saying we can't afford this house anymore. But there's a couple things that you want to pay attention to. Number one, housing prices drop much slower than they go up. And number two is mortgage rates could potentially go down to increase demand again. Let's start by talking about the velocity of housing prices, because if you are a home seller, let's assume that you own this house and it's valued at $400,000 today, and somebody comes up to you and they're willing to offer you 20% over asking price. They say, we're gonna give you $480,000 for your house. What are you gonna say? Absolutely. You're going to pay me more money than I thought. I will sell you that house. But if somebody comes up to you and they say, we will be willing to give you 20% below market value, now it's a different scenario. So if somebody offers you $320,000 for your, what you believe is worth $400,000 house, now instead of immediately saying, I'm going to cut the price of my house, you might say, let me wait a little bit longer. Let me see if I get any more offers. Maybe you'll cut the price by $5,000 or $10,000 and see what happens, because you're going to be less anxious and excited to cut the price of your house as you would be to raise the price of your house, which is why home prices move up much faster than they go down. So keep that in mind. But then you also have to take a look at what factors could impact demand, because if we see more buyers enter the market, well, then that could also even out housing prices to potentially not see housing prices fall. And which factors impact demand? Well, people's ability to be able to afford the house, which can include mortgage rates. The Federal Reserve Bank is the central bank of the United States, and they have the ability to influence interest rates. Now, these interest rates are not your mortgage rate, but it can influence the mortgage rate that your bank costs you. Now, President Trump has made it very clear that he wants to see lower interest rates by the Federal Reserve Bank, and up until very recently, the Federal Reserve Bank kept saying that we are not going to cut interest rates because we are concerned about tariffs, we're still concerned about inflation, we don't know what's going to happen in the economy, economy, so we're not going to cut interest rates anytime soon. Well, very recently, President Trump met with Jerome Powell, who is the chairperson at the Federal Reserve Bank, and now we're starting to hear more discussion that maybe the Federal Reserve Bank is open to the idea of cutting interest rates sometime soon, although the Federal Reserve Bank has also said that they're not going to play politics at all. Now, was Jerome Powell influenced by President Trump? I don't know. But what I do know is if interest rates do fall, and let's just say hypothetically, mortgage rates were to go down to 5%, that could very likely increase demand. How much? We don't know. But if we see an increase in demand and it outpaces the number of sellers, that could push home prices up again. But there's two things you want to remember before I leave you on this video, which is there's two reasons that could bring us down to 5% mortgage rates. Number one is we enter a recession. Number two is because of time. Number one, if you enter a recession, well, the Federal Reserve Bank generally cuts interest rates when we are in an economic slowdown. Remember 2020, the pandemic happened, the Federal Reserve Bank cut interest rates to stimulate the economy. So if we enter a recession, a slowing economy, we could see lower mortgage rates, which would then boost the housing market in terms of demand. The other reason is if we just keep waiting until things get calmed down with inflation and tariffs, and then the Federal Reserve Bank says it's time to cut interest rates. Which one is it going to be? I don't know. But those are the factors that you want to pay attention to. So if you're thinking about buying a house, the thing that I'm going to leave you with that I always want you to remember is buy a house you can afford. Don't try to time the housing market, because what I believe is that the house that you live in is not an asset, it's a liability. If you treat it like a liability, now you can work on building real wealth outside of just the house that you live in.
Do me a favor and hit that YouTube tip jar. Hit that like button. Ka-bing! Like that. Thank you so much. And I would love it if you subscribed. I could really use some subscribers. So help me out. Talk to you soon. See you next week.